I want you to do yourself a favor, and after you watch this video, go into your own accounts receivable aging summary. I've got a sample QuickBooks test drive screen up here for demonstration's sake, but every program, every accounting software should have its own version of the AR aging. And that's just breaking down your accounts receivable by customer and by the age of the invoice since it's been billed out. So we have a sample in front of us. This 781 should tie to our trial balance amount. We're good there. What we should be looking for are credits here. Okay, and credits could come about any which way. You issue a credit memo so the customer doesn't owe you as much as you had originally billed them. But what can happen, and what I see happen often, is recording a cash receipt without ever billing the client. So as you recall, when you bill a client, you debit accounts receivable, you increase it, and you credit revenue. You increase revenue. That's the standard process. And then when you receive the cash, you debit cash and you credit AR. So in the end, you're left with cash and revenue. That AR flushes out. Now, what I've seen happen is the client will skip the first step, not intentionally, just it happens, mistakes are made. They'll skip the first step and go directly to the second one of debiting cash because you're increasing cash and crediting accounts receivable. So what that does is, one, it understates your receivables, and two, it understates your revenue. So contractor-wise, you're understating your billings to date, which isn't good. And two, you're understating receivables. If you remember early in the video, we discussed the standard process for recording revenue. You record a receivable, you debit receivable, credit revenue, increase asset, increase billings, and then when you receive the cash, you debit cash, credit AR. Assume that the error we've been talking about is for $4,500. Okay, so we recorded a receipt for $4,500 and we credited receivables for that amount. We skipped this step altogether. So we have no billings on the job and we have negative AR. When we get to the balance sheet, we see the 782 in the receivables. We see total current assets of 4,782 and total liabilities of 4,000. That gives us a working capital calculation of $782. Now, when we go to the corrected balance sheet, huge difference here. Look at the receivable balance is $5,282, giving us total current assets of $9,282. Versus the $4,000 in current liabilities, that's $5,282 in working capital. Huge difference here because we corrected it. We either recorded a journal entry for the invoice, so we have something to offset this negative AR by debiting the AR. We also increased billings. This made a huge difference. So you want to make sure that you keep that AR aging schedule clean because it could be skewing things dramatically. And in this case, your working capital is suffering. You know, underwriters issue bonding capacities based on your working capital. Some may include underbillings and overbillings, some may not. In this example, we're including them, but just look at the big difference here. $782 versus $5,282. Big difference, just because we scanned that AR aging summary. So again, go into your own receivable schedule and try to identify potential issues with the billing and cash receipt cycle. You may need to record an adjustment to properly state your receivable balance. Thanks again for tuning in. I'll see you in the next lesson.